On February 26th, mortgage rates dropped below 6% for the first time in 3.5 years. 2 days later, the bombs started falling on Iran. 6 weeks later, rates hit 6.46%. Gas hit $4. Inflation jumped to 3.3%. And the best spring buying season in years just got torched. Today, 10 ways this war is wrecking the housing market and what you can actually do about each one. Number 1 is the one nobody's talking about yet. Let's go. Number 10. The rate whiplash. From hope to heartbreak in 6 weeks. Here's the cruelest part of this whole thing. For the first time since late 2022, mortgage rates finally cracked below 6%. Freddie Mac confirmed it. 5.98% for the week ending February 26, 2026. The housing market was about to exhale. People who'd been waiting 3 years, sitting on the sidelines, watching prices climb while their savings lost ground. They finally saw a door opening. Mortgage applications jumped. Realtors started booking showings. It felt like something was about to break free. Then February 28th happened. US and Israeli forces launched nearly 900 strikes on Iran in 12 hours. Iran closed the Strait of Hormuz, the choke point for 20% of the world's oil supply. Oil shot toward $100 a barrel. Treasury yields spiked because investors suddenly got very nervous about inflation. And mortgage rates, which track the 10-year Treasury, followed them up like a rocket. By the first week of April, according to Freddie Mac's weekly survey, the average 30-year fixed had climbed to 6.46%. That's basically half a percentage point in 6 weeks. On a $400,000 home with 20% down, that's roughly an extra $83 a month. Doesn't sound like much? Over 30 years, that's nearly $30,000 more in interest. For a rate move that had nothing to do with you, your job, or your credit score. A war 6,000 miles away just added 30 grand to your mortgage. So what do? If you were pre-approved in February at 5.98% and your lock expired, talk to your lender right now. Some lenders will offer a float-down option on a new lock if rates improve later. That's your insurance policy. If you haven't locked yet, don't panic buy a rate. The Mortgage Bankers Association still projects rates settling into the low 6s by late 2026 if the conflict doesn't escalate further. The worst move right now is locking in at the peak of fear. The second worst move is waiting forever because you're chasing 3% rates that aren't coming back. And here's the thing that stings the most. That 5.98% was already considered historically expensive. 20 years ago, people complained about 6%. Now it felt like a gift. That's how warped this market has become. A rate your parents would have walked away from is now the one you're praying to get back to. We're just getting started. Number 9 hits your wallet at the gas pump and then follows you home. Number 9. $4 gas is eating your down payment. You pull up to the pump in early April 2026, and the number staring at you is $4.16 a gallon. According to AAA, that's the national average as of April 9th, up over $1 from February, and the highest since 2022. In California, you're looking at $5. In parts of Nevada and Washington, close to it. Now, most housing videos don't talk about gas prices, but they should, because here's the math nobody's doing. The average American drives about 13,500 miles a year, according to the Federal Highway Administration. At 25 miles per gallon, a pretty standard sedan, that's 540 gallons. At $4.16 a gallon, you're spending roughly $2,245 a year on gas. In February, when gas was around $3.04 nationally, that same driving cost you about $1,640. That's an extra $600 a year. If both you and your partner drive, that's $1,200 gone, just from gas. That's money that was supposed to go into your savings, your down payment fund, your emergency buffer. And it doesn't stop at the pump. According to the Bureau of Labor Statistics, the March 2026 CPI report showed gasoline prices jumped 21.2% in a single month. Energy overall was up 10.9%. That pushed total inflation to 3.3% year over year, up sharply from 2.4% in February. The OECD now projects U.S. inflation will hit 4.2% for 2026, up 1.2 percentage points from their pre-war forecast. Higher inflation means the Federal Reserve has less room to cut interest rates. Less rate cutting means mortgage rates stay elevated, which means your monthly payment stays high. It's a chain reaction, and it started with a conflict in the Persian Gulf. If you're saving for a home, here's the uncomfortable advice. Recalculate your budget right now, not the one from January, the one that accounts for $4 gas, higher grocery bills, and the possibility that rates stay above 6% through 2026. Build your plan on reality, not the reality you were hoping for. If your monthly surplus just got eaten by energy costs, that's not a failure. It's the economy doing what it does during a war. Adjust. Don't abandon the goal. Just move the timeline. Oil was $103 a barrel as of April 13th, according to Yahoo Finance using the Brent benchmark. Goldman Sachs warned that if the Strait of Hormuz stays closed much longer, countries could face actual oil shortages. We're not there yet, but nobody expected $4 gas in March either. Number 8 is about what happens when sellers panic and buyers freeze at the same time. Number 8. The biggest gap between sellers and buyers in over a decade. This is where it gets structural. According to Redfin, in February 2026, there were approximately 46% more home sellers than buyers in the U.S. market. That's 629,808 more sellers than buyers, the largest gap in Redfin's records going back to 2013. Not 2020, not 2008. The widest mismatch they've ever recorded. Think about what that means. Almost half again as many people trying to sell as people trying to buy. That's not a healthy market. That's a market where sellers are competing against each other, lowering prices, offering concessions, and still waiting weeks, sometimes months, with no offers. And here's where the war made it worse. That gap was already building through late 2025. But when rates whipped from 5.98% back to 6.46%, a bunch of buyers who were just getting off the sideline went right back to sitting down. Mortgage applications dropped 10.4% in the last week of March, according to the Mortgage Bankers Association. Purchase applications fell for 3 straight weeks. Meanwhile, sellers, especially those who need to move for jobs, divorce, retirement, downsizing, can't just wait. Life doesn't pause because Iran is in the news. Miami, Nashville, and Austin are among the metros where sellers most outnumber buyers, according to Redfin's analysis. In the AP's reporting, 43 of the 50 largest metro areas had more homes for sale in February than a year earlier, with listings up between 10% and 38% in places like Seattle, Indianapolis, Las Vegas, Houston, and Denver. The median listing price was down year over year in more than half of the 50 biggest metros, nearly 9% in Austin, more than 5% in Washington, D.C., San Diego, and Los Angeles. If you're a buyer right now, this is your leverage moment. You have more negotiating power than at any point since 2013. Ask for below list. Ask for seller concessions on closing costs. Ask for repair credits. Sellers in oversupplied markets are saying yes to things they would have laughed at in 2022. Ann King in Fort Worth got $10,000 off the list price, $5,000 toward closing costs, and another $12,000 in repair credits, all before the war even started. Imagine what you can negotiate now. If you're a seller, be honest with your agent. Price competitively from day one. Every week your home sits, you lose leverage. In this market, overpricing isn't ambition, it's self-sabotage. That seller-buyer gap is historic. But number 7 shows you what happens when entire cities start bleeding value at the same time. Number 7. The Sunbelt reversal. Former boomtowns are now leading the crash. This one is poetic in a painful way. The American Enterprise Institute Housing Center just released data showing that 28 out of 53 of America's largest metros saw price decreases in the 12 months ending February 2026. Not slower growth, actual decreases. And the cities getting hit the hardest? The exact same ones everybody was fighting to move to 3 years ago. Cape Coral, Florida, down 9.6%. Northport, Florida, down over 6%. Memphis, down. Tucson, down. Palm Bay, Florida, down. Austin, Texas, which literally doubled in price between late 2019 and mid-2022, according to AEI data, going from $297,000 to $593,000, is now bleeding value, with prices down 3.6% to 6.8% year over year, depending on the index, and sitting at 6.5 months of inventory, with 91+ days on market, according to local MLS data reported by LRG Realty. Meanwhile, guess who's winning? Kansas City, up 8.6%, Pittsburgh, up 5.8%, Cleveland, up 5.9%, Chicago and Philadelphia, up about 4% each. The boring, affordable, nobody moves there cities are suddenly the smart money. The AEI's Ed Pinto calls it the affordability economy. People are moving where they can actually afford to live. Imagine that. The AEI is projecting that by the end of 2026, single-family home prices nationally will be 1% lower than the start of the year, with drops of 2% projected for 2027 and 2028. And those are national numbers. In the Sunbelt hotspots, the damage will be worse. What does this mean for you? If you own in Cape Coral, Austin, or any of the 28 declining metros, don't panic, but do the math. Check your home value on Zillow or Redfin today, compare it to what you owe, and calculate your real equity position. If you bought in 2021 or 2022 at the peak, especially with a low down payment, you could be closer to underwater than you think. If you're looking to buy, this is the punchline. The Sunbelt might not be where the deals are. The deals might be in the Midwest and Northeast, where prices are rising but still affordable. A $220,000 home in Cleveland that's gaining 6% a year is a better bet than a $450,000 home in Austin that's losing 5%. The Sunbelt is always going to be the Sunbelt, but right now, the math is in the Rust Belt's corner. Number 6 is about the people who were supposed to buy this spring, and why a million of them just said forget it. Number 6. The spring buying season, dead on arrival. Every year, the housing market has a rhythm. January and February are quiet. March through June, that's when the action happens. Families want to move before the school year. The weather's nice. Tax refunds hit bank accounts. It's the Super Bowl of real estate. This year, it was shaping up to be the best spring in 4 years. Rates had just dropped below 6%. Inventory was finally building up. Even the National Association of Realtors was cautiously optimistic. Their February report showed existing home sales up 1.7% month over month. Then the war hit, rates reversed, gas prices exploded, and consumer confidence cratered. The University of Michigan's Consumer Sentiment Index dropped to 47.6 in April 2026, an all-time record low. Not 2008 low, not 2020 low, the lowest reading ever recorded. People aren't just worried about buying homes, they're worried about everything. And the March existing home sales data, just released by NAR yesterday, down 3.6% from February. Sales fell in every single region of the country, month over month. The national median sales price was $408,800, and inventory sat at 4.1 months. That's still technically a seller's market by the old 6-month rule, but the direction is unmistakable. Supply rising, demand falling. According to Realtor.com, the gap between sellers and buyers is at a record. According to the MBA, mortgage applications have been declining for weeks. The spring market didn't just slow down, it froze mid-thaw. Here's the practical side. If you're a buyer who was planning to buy this spring, the calculus just changed, but maybe in your favor. When everybody else pulls back, competition drops. Bidding wars disappear. Sellers get desperate. The AP reported that in the Dallas-Fort Worth metro, sellers are already offering price cuts and concessions that would have been unthinkable a year ago. You might not get a 5.9% rate, but you might get a $20,000 price reduction that more than makes up for it. The worst thing you can do right now is follow the herd. When the herd freezes, the contrarian eats. Just make sure you can actually afford what you're buying at a 6.3% rate, not a hypothetical 5% rate. Gail and David Sanders in Olathe, Kansas, listed their home in late February at $535,000. They dropped to $525,000. Still no offers as March ended. That's your market right now. Number 5 is about what happens when your home equity starts evaporating, and why this time it's different from 2008. Number 5. The equity erosion nobody warned you about. Here's the number that should make every homeowner sit up. More than 1.1 million borrowers ended 2025 underwater, meaning they owe more on their mortgage than their home is currently worth. According to ICE Mortgage Technology's February 2026 Mortgage Monitor, that's the highest level since early 2018, and it's concentrated in a very specific group. Among FHA-backed loans, 5.7% were underwater. Among VA-backed loans, it was 9.6%. But here's the gut punch. Of mortgages originated in 2024, more than a quarter of VA borrowers and nearly 17% of FHA borrowers were already in negative equity. These aren't people who've been paying for 20 years. These are people who bought recently, with low down payments, at or near the top. They did everything right, used the government programs designed to help them, stretched to afford a home, and the market punished them for it. Now combine that with the AEI data showing prices declining in 28 of 53 major metros, and with the war pushing rates higher, making homes less affordable, meaning fewer buyers, meaning further price declines. It's a feedback loop. Less demand, lower prices, more people underwater, more people can't sell, less inventory turnover, market gets sicker. ATTOM Data's February 2026 foreclosure report adds another layer. Foreclosure filings hit 38,840 properties nationally, up 20% from a year ago, the 12th consecutive month of annual increases. Foreclosure starts were up 14% year over year. Completed foreclosures were up 35%. Indiana, South Carolina, and Florida lead the nation in the worst foreclosure rates, with Lakeland, Florida, at one foreclosure filing for every 1,075 housing units. What should you do? First, check your equity. Not what Zillow said 6 months ago, what it says today. Subtract what you owe. If the gap is shrinking or gone, you need to know now, not when you're trying to sell. Second, if you bought in the last 2 years with less than 10% down in a declining market, talk to your lender about your options before you're forced into them. Loan modification, recasting, or even waiting it out might be smarter than selling at a loss. This isn't 2008. ATTOM's own CEO said foreclosure levels are still below historic norms. But the direction is wrong, and the war just added fuel. For the million-plus families underwater right now, that direction is the whole story. Number 4 is about the invisible tax that just got bigger. Number 4, insurance and property taxes. The war tax you didn't vote for. Everybody talks about mortgage rates. Nobody talks about the other mortgage, the one you pay on top of your mortgage that never goes away and only goes up. Property taxes in the United States went up nearly 25% between 2019 and 2025, according to data compiled by ATTOM. Delaware saw an 18% spike. Maryland, 11.6%. 13 states are now actively considering measures to reduce or eliminate property taxes. That's how bad it's gotten, according to Realtor.com. When politicians start talking about abolishing a tax, you know the public is furious. Then there's insurance. Home insurance premiums are projected to rise another 8% in 2026, a 5th straight year of increases, according to Cotality projections reported by Insurance Journal. The average annual premium is expected to surpass $3,000 for the first time ever, per an Insurify report. California is expected to see 16% increases, Nebraska, 13%, New Mexico, 11%. Now here's where the war multiplies the pain. Rising oil prices mean higher construction material costs. Steel, lumber, concrete. All of it requires energy to produce and transport. Higher replacement costs mean higher premiums, because your insurance company has to cover the new, inflated cost of rebuilding your house. It's a conveyor belt of inflation that runs from the Strait of Hormuz straight into your mailbox. Add it up. On a $400,000 home, you might be paying $2,400 a month in mortgage principal and interest at a 6.3% rate. Tack on $350 a month in property taxes and $250 in insurance. That's another $600 a month. Some markets, that number is closer to $800 or $1,000. In parts of Florida and Texas, homeowners pay more in taxes and insurance combined than they do on their actual mortgage. Nobody told them that at closing. Here's what you can actually do. 1. Appeal your property tax assessment. In most counties, you can file a protest within 30 to 60 days of receiving your assessment. Studies show that homeowners who appeal win a reduction about 40% of the time. 2. Shop your insurance annually. Get 3 quotes minimum. Raise your deductible if your emergency fund can handle it. 3. Before buying anywhere, calculate the full monthly carrying cost, not just the mortgage. The house isn't just the house. It's the house plus everything the government and the insurance company take. The total cost of ownership in 2026 is a different animal than 2019. If you're not running those numbers, you're flying blind. Number 3 is about the people who can't sell and can't afford to stay. Number 3, the lock-in trap just got tighter. There's a term in real estate that didn't really exist before 2023, the lock-in effect. It's when homeowners with ultra-low pandemic-era mortgage rates, 2.5%, 3%, 3.5%, refuse to sell because selling means giving up that rate and buying into today's market at 6% plus. It's golden handcuffs. You've got a beautiful rate, but you're stuck in a house that might be too small, too far from family, or in a market that's declining. A Storable study reported by Yahoo Finance in February 2026 found that nearly half of Americans feel trapped in their homes because of the rate lock-in. They're delaying career moves, postponing life milestones, even putting off relationships, all because the math of moving doesn't work. And the war just made it worse. That brief window in late February, when rates dipped below 6%, was the first real escape hatch in 3 years. For a few days, the lock-in gap narrowed enough that some people could move and not feel like they were lighting money on fire. Then February 28th happened, and the gap blew wide open again. Right now, the average outstanding mortgage rate is somewhere around 4%, according to Harvard's Joint Center for Housing Studies. Market rates are at 6.3%. That's a 2.3 percentage point gap. On a $350,000 loan, that's roughly $500 more per month to carry the same amount of debt, per month, for the next 30 years. So millions of homeowners are frozen. They can't sell without a massive hit to their monthly budget. But they also can't ignore that their home is losing value in places like Austin, Cape Coral, or Memphis. It's the worst of both worlds. Your asset is declining, and you can't exit. What can you do? First, if you need to move and you have significant equity, consider keeping your current home as a rental and buying the next one. You keep the low rate, the tenant covers the mortgage, and you enter the new market as a buyer with negotiating leverage. It's not simple, but it's math that can work, especially in markets with strong rental demand. Second, if your timeline is flexible, watch for a ceasefire or peace agreement on Iran. Any de-escalation in the conflict will likely push Treasury yields down and mortgage rates with them. The MBA still projects rates settling closer to 6% by late 2026 under a peace scenario. That might be your window. Third, stop comparing today's rate to your pandemic rate. That rate was a historical anomaly created by a once-in-a-century crisis. 6% was normal for decades. It's the expectation that was abnormal, not the rate. The lock-in effect was already a crisis before the war. Now it's a trap with a tighter lid. We're heading into number 2, and this one's about what the government data says versus what you see with your own eyes. Number 2, inflation is back, and the Fed just lost its exit ramp. Remember when inflation was supposed to be beaten? In February 2026, the annual CPI rate was 2.4%. The Fed was on a glide path. Rate cuts were on the table. The housing market was about to benefit from gradually falling borrowing costs through 2026 and into 2027. Every forecast, from the Fed, from Zillow, from the MBA, from Redfin, was built on that assumption. Then the Strait of Hormuz closed. Oil hit $100 a barrel. Gasoline crossed $4 a gallon. And in March, the CPI jumped to 3.3% year over year. According to the Bureau of Labor Statistics, gasoline prices surged 21.2% in a single month. Energy costs overall were up 10.9%. It was the sharpest monthly spike in gas prices since 1967. The OECD revised its U.S. inflation forecast to 4.2% for 2026, a full 1.2 percentage points higher than their pre-war projection. Harvard Business Review is openly asking whether this war will deliver the recession economists have been predicting for 3 years. Here's why this matters for housing. The Federal Reserve can't cut interest rates when inflation is accelerating. And if the Fed can't cut, mortgage rates have no reason to fall. Every housing forecast that assumed 5.5% to 5.8% rates by late 2026, those are in the trash now. The new baseline, according to multiple analysts, is rates staying in the 6% to 6.5% range through the rest of the year, possibly longer if the conflict drags out. The Conference Board's Consumer Confidence Index was already weakening. Then in April, the University of Michigan's Sentiment Index crashed to 47.6, the lowest reading in the history of the survey. Not just low, the lowest ever. People are scared. Recession probability estimates from economists are now in the 30% to 49% range, per Indexbox research. Some Wall Street firms are higher. What does this mean practically? If you were betting on a rate drop to buy a home in the second half of 2026, you need a backup plan. Budget at 6.25% or higher. If rates drop, great, you can refinance. But don't build your financial life around a rate prediction that was made before a war started. Budgeting for the worst case and being pleasantly surprised is always smarter than budgeting for the best case and getting crushed. For current homeowners, rising inflation erodes your real equity, even if your nominal price stays flat. If your home is worth the same dollar amount it was a year ago, but inflation is running at 3.3%, you've actually lost purchasing power. That's the silent thief. As of April 13th, oil was at $103.72 a barrel, according to Yahoo Finance. The U.S. has imposed a blockade in the Strait of Hormuz. Peace talks yielded little over the weekend. This isn't going away soon. And that brings us to number 1, the consequence nobody's talking about, the one that changes the game for the next generation. Number 1, a generation locked out. The dream isn't deferred, it's dying. Here's the number that should haunt you. The median age of a first-time homebuyer in the United States is now 40 years old. 40. According to the National Association of Realtors, that's an all-time high. In 1981, it was 29. In 2000, it was 31. It just keeps climbing, year after year, and every single shock to the system, pandemic, inflation, rate spikes, and now a war, pushes it further. To afford the typical U.S. home for sale, you need a household income of $111,252 a year, according to Redfin data from February 2026. That's down 4% from the $115,870 needed a year ago. But here's the joke. The national median household income is roughly $80,000. So the typical home requires 39% more income than the typical family earns. And that was the calculation before the war pushed rates back up and inflation spiked to 3.3%. Run the numbers on today's market. A $408,800 home. That's the national median sales price per NAR's March 2026 report. Put 20% down. That's $81,760 in cash you need to have saved. Finance the rest at 6.3%. Your monthly principal and interest is about $2,030. Add property taxes, insurance, possibly PMI if you put less down. You're at $2,700 to $3,200 a month. To qualify under standard lending guidelines, you'd need a gross monthly income of roughly $9,000 to $10,000. That's $108,000 to $120,000 a year. Now overlay the war effects. Gas at $4.16 is eating into savings. Grocery inflation is back. Job losses hit 92,000 in February before March added back 178,000. But the labor market is wobbly, with unemployment at 4.3% and declining confidence everywhere. Young people aren't just priced out of homes. They're being squeezed from every direction simultaneously. Student loans, rent, car payments, insurance, and now energy costs that are 30% higher than they were 2 months ago. In 1985, the average home cost roughly 3 times the median annual salary. Today, it's over 5 times. Your parents bought a home with 1 income and a handshake. Your kids can't buy one with 2 incomes and a perfect credit score. That's not a market correction. That's a structural failure. And every crisis, from 2008 to COVID to this war, widens the gap. Each one takes the ladder and moves it one more rung higher. What can you do? If you're a parent with adult children who want to buy, have the money conversation now. A family-backed down payment or a co-signed loan might be the only realistic path in this market. It's not failure, it's adapting to a system that was never designed for this level of cost. If you're the one trying to buy, look at the markets where affordability still exists. Those Rust Belt and Midwest cities showing price appreciation and still priced under $250,000. Kansas City, Cleveland, Pittsburgh, Indianapolis. They're not glamorous, but they're where the math works. And here's the absurdity that should make your blood boil. While a generation is locked out, more than 1.1 million homes are sitting unsold across the country. Builders are offering rate buydowns, closing cost credits, and price cuts of 15% to 20% in oversupplied markets. There are literally more sellers than buyers by the widest margin in a decade. The homes exist, the people exist, the system just can't connect them. That's not a supply problem or a demand problem, it's a broken machine. This war didn't create the housing crisis, but it just showed everyone, in 6 brutal weeks, how fragile the whole thing was. 10 consequences. 6 weeks of war. A spring season wrecked, rates reversed, inflation roaring back, and a generation watching the dream drift further away. This isn't 2008. It's quieter. But for anyone not paying attention, it's just as dangerous. Check your equity. Recalculate your budget. Stop waiting for the rate that isn't coming. And make your next move based on what the numbers say today, not what they said in February. The math doesn't care about your feelings, but it always rewards the people who do it.